Welcome to Marketopolis, at the crossroads of Wall Street and the internet. In a feed-driven era powered by Reddit, Robinhood, YouTube, X, and many other platforms, retail investors drive the conversation online. Corporate access has been blown wide open, conversations move at the speed of social platforms, and CEOs, IROs, and comms teams are rewriting the investor relations playbook in real time. I'm Matt Giuano, CEO of Stakeholder Labs. Each episode, I talk with public company CEOs and top operators to uncover fresh strategies for communicating and competing in today's markets. Whether you hold a single share or just love the story, you'll take away practical lessons for navigating modern public markets. This is Marketopolis. Let's get into it. Today on Marketopolis, we're going inside a company that's quietly outlasted and out-executed across 4 decades of market cycles. Dynex Capital is the oldest mortgage REIT on the New York Stock Exchange, and Co-CEO and President Smriti Popenoe joins us to unpack how they navigated capital management, rebuilt through the financial crisis, and why double-digit dividends is more than a headline, it's a risk tool. We get tactical on a week in the life of a modern CEO, the discipline behind leaving white space for deep work, and a career philosophy that evolves from learning, leading, and embracing the unknown. Then we zoom out, what falling rates mean for income investors, how retail is closing the research gap with AI, and why tokenization could fundamentally change how markets operate. Whether you're here for leadership playbooks or portfolio construction, this one's a masterclass in stewardship, strategy, and staying power. Let's jump into it. The future of air travel is fast approaching, and to help shape it, Surf Air Mobility is building a platform to bring together AI-enabled software, electrified aircraft, and a nationwide flight network targeting an estimated $100 billion regional air mobility market by 2035. Their SurfOS software, powered by Palantir, is designed to be the intelligent operating system for private aviation and air mobility. And with over $100 million in annual revenue and the owner of one of the largest commuter airlines in the U.S., Surf Air Mobility is uniquely positioned to advance next-generation technology across the industry. To learn more about Surf Air Mobility, visit surfair.com/marketopolis. Before we begin, please note that this conversation may include forward-looking statements. These statements are subject to risks and uncertainties, which are described in the company's SEC filings and investor relations materials. The views expressed in this discussion are solely those of the guest and do not necessarily represent the views of the host or the show. This discussion is for informational purposes only and should not be taken as investment, legal, or tax advice, nor as a recommendation to buy, sell, or hold any security. You should always consult with a qualified financial advisor or tax professional before making investment decisions. The host and guest disclaim any liability for losses that may result from reliance on this discussion. Remember, all investing involves risk, and past performance is not a guarantee of future results. Hi, Smirthy. Excited for this conversation. Welcome to Marketopolis. We're going to jump right in. If you want to kick things off and tell us a little bit about Dynex, that'll give the audience some context. So I'll hand it off to you. Let's give a high-level overview on Dynex.
Perfect. Thank you, Matt. And it's great to be here to talk about Dynex. Amazingly, we are the oldest mortgage REIT in existence. We've been around since 1988, traded on the New York Stock Exchange. So long track record for this company. And really the iteration that we're in right now started in 2008, about 17 years ago. I think of us as a company that operates at the intersection of capital markets and housing. So we sit at the very center of that. And we raise capital from the capital markets. We invest that capital in housing. And most times when you think of a REIT, you think about people that invest in brick and mortar buildings. We actually invest in the mortgages that finance those buildings. So that's why we're called a mortgage REIT. One of the distinguishing features about Dynex actually is our dividend. So our stock currently pays a dividend about 16.5%. And we're able to generate this from investing in these mortgage assets.
I love that. So 30 plus year old company, or at least publicly traded for 30 plus years. Are you able to share a little bit about the early days of this company? I know it's way before your time, but how Dynex went public and then what it's looked like the past 30 plus years into maybe today, the modern era of the company?
Absolutely. Yeah. So in the 30 years since IPO, our total return is over 500% through many, many different business cycles. And it's important to think about, like, yes, there were a bit different iterations of the company that reflected what was really going on in the housing market. So the first 10 years of Dynex, 1988 to 1998, they were an early innovator in housing finance. And what we see in the mortgage markets today was very different in the late 1980s going into 1998, where the first real securitizations were happening. So this company did manufactured homes, they did new home financing, they pioneered a lot of new things in terms of structures in the housing market. And then in 1998, there was a market event, that long-term capital crisis, that changed the game for Dynex. And for the next 10 years, they actually worked themselves out of that crisis situation, shrinking their balance sheet, paying off all their lenders, which is a real testament to the way the management of the company dealt with a crisis. And really, the company stayed in sort of a dormant state until 2008. In 2008, the people that owned the company at the time came to my co-CEO, Byron Boston, requesting him to come run the company because he had a business plan. Amazingly, right as the crisis was hitting. So he started in January 2008 and built this company. And I've been alongside him since 2014, bringing it to where we are today.
I love that. That very helpful context and background. Maybe shifting to your journey. So you joined, as you mentioned, you're now the co-CEO and president. Let's go back in time. How did you get here? Where did you start? What were some of the formidable chapters in your journey?
Yes. And the way I think about this is really in any person's career, I think you go through these stages. I came to the U.S. At the age of 21 with an undergraduate degree in chemistry and environmental science. So
Wow.
Completely not thinking that I would be a financial professional for as long as I have been. When I got here, it was very interesting. The job market was tough, and I had this dream of being a scientist, and learned very quickly that you need a PhD to be a scientist of any kind. And so I got a part-time job selling mutual funds and insurance. And when I stepped into that world, it was as if, I had this feeling of oh my gosh, where has this been all my life? It was just so fascinating to understand the movement of money and economics. So I fell in love with it. And then it inspired me to get my MBA and then my CFA. And then stepping into these early jobs, basically, I would say it was all about what you know and how quickly you could learn. So the first 10 years of my career, I just spent learning, absorbing things like a sponge. My first day of work was at a company called Freddie Mac, which was a public company at the time. My boss handed me a book called The Handbook of Mortgage-Backed Securities. And he said, read this, and when you're done, come talk to me. So
this is your Bible. Go study it.
Yeah. So I studied it. It took me about 2 weeks to get through it. So 1,000+ pages. And so that part of my life was really about learning. And then there was a second 10 years that was about applying a lot of that learning and learning more than how to teach people and manage people. And the last 10 years has really been about being more strategic. And in that time frame, I would say it has been less about what I know and less about what I have learned and more about what I don't know and being comfortable with that. So the journey to co-CEO is really a journey of getting more and more comfortable with not knowing.
Yeah, it's fascinating. I like how you frame that. Talking about learning, applying, and then being in this stage of being comfortable with what you don't know. It's interesting how you deal with risk on a daily basis. That's been your career. How do you think about risks in your actual career and choosing jobs? How did you decide to make the jump from one company to another? When did that really tip and become an obvious decision?
Yeah, it's sometimes there are instances in your life where you don't get to make that choice. That's happened to me a couple of times where it's literally I didn't get to make the choice to leave some of my companies. And when I did, I it was more about how I reacted, how I responded to that moment. And one of the biggest things I learned was how not to identify myself with what I did. And so when the choice was given to me, in the sense that, you're either going to stay or you're going to leave, and you don't have a choice, I made it less about Smirthy and more about sort of the situation. And that allowed me to have the strength to say, okay, look, this is not the situation for me. I need to create a different situation for myself. And how do I create that? And every time I've had that experience, I've had it now twice in my career, I've turned it into something that was much better than what might have possibly happened had I stayed. So so in my career, it's been that way. And the risk management aspect of that, or really actually choosing, there was a time when I did actually choose to leave a company. In that moment, it was more about principle, like how I felt when I went to work, how I felt about the people I was working with, how I felt about the ethos and the ethics of the company. And when I felt like that didn't fit me as well, I did make the conscious choice to go start my own consulting business, and versus, making the compromise with myself to stay at a place that, didn't fit me as well.
And kind of building on your job not being your entire identity at Dynex, what is the day in the life of a co-CEO and president look like? What's your average day, or maybe what are the days like in a week when you're helping to run this company?
Yeah, this has been something. So I've been the co-CEO now for about 15 months, and my life changed dramatically from when I was not the co-CEO to when I am. And it's been super interesting just for me to observe. So I spend some time every day in meetings of some sort with my team. And we're solving issues of the day, or issues of the week, or issues of the month, or we're doing planning. So there's a lot of that. But a lot of my day is actually, I leave open and unscripted for me to be able to either take time away from the business to think about the business, think more strategically about, where we are, what we're doing, how we're getting there. I leave time open in my calendar to make sure, if my team needs me to help them get resources, for example, consulting or advisory things, I have time to do that. So I actually do not schedule myself where I'm going meeting after meeting back to back. There's space in my schedule. There's space for personal time. I'm very committed to a yoga practice. So I do a yoga practice twice a week. Sometimes it's during the day, and I have to take time out of my work to do that.
Is it a particular yoga practice, or just yoga in general? Do you have a school of yoga that you subscribe to?
I don't. I actually have a yoga teacher who I subscribe to, and it's a one-on-one class. And it's just such a great way to build inner strength, both spiritually, mentally, as well as in your body. When you're in the CEO seat, so many people are depending on you, and I want to bring my A game every single day, and I've got to have a disciplined practice to be able to bring that A game. So I do focus my off time on making sure I stay sharp on the A game. And then while I'm here, the best thing I can offer my company and my shareholders is just really focused presence. And when I bring that focused presence, I find the ability to solve problems, and just go thinking into the future is actually really, really supported.
Yeah, I love that. Leaving the space to not be in back-to-back meetings, to actually have some of that deep work, that deep thinking on a consistent basis, and managing beyond your professional side, your health, your physical, your spiritual side of yourself, so that you can bring your full self to the job and the role.
One of the things I tell my team is you've got to have, in these seats, in any seat, You need to have a professional strategy. So that says, here's what I'm being asked to deliver. How am I going to deliver? Do I have the skills to deliver it? Do I need to build any skills? Right. So you need to have a professional strategy, but you also have to have a personal strategy. How much time of the day am I going to devote to work? And when am I, and for me, actually, right now in the CEO seat, in the co-CEO seat, I tend to work like at all hours, and it's not necessarily just like a 9 to 5 or 8 to 5 job. And that's so work and home and everything else tends to be more fluid. So my personal strategy for that, so I have a strategy, right? So if you don't have a personal strategy or professional strategy, you tend to drift and maybe not have such direction. So what I say to my team is, having a lot of intention, making sure what your personal and professional strategy are to be able to navigate such things.
I like that a lot. And I think, especially in your role, there's a lot of balance and balancing across a lot of different uh, dimensions and people wanting your time, other companies wanting to talk to you, the markets, and maybe on that point, a lot of the CEOs we talk to, they say they kind of have two jobs. They have to run the company, and then they have to navigate the public markets. How do you think about balancing those two sides of the co-CEO job, where especially with a company like Dynex, public markets, how they're reacting, their perception is very important, and then just the general macro environment. So how do you balance both sides of that role?
Well, one awesome thing I have is a co-CEO, right? So our thought process in having two CEOs is recognizing, there are actually those two jobs. One is to operate the company and dealing with the public markets, but also I would say there's probably like 5 or 6 jobs really sitting in the CEO seat, right? And when you're an entrepreneurial company like we are, we've doubled the size of our company in the last year, and we're still want to double it again. I want to grow our company. When you're in that mode, you are the chief marketer. You are the person who's taking care of your stakeholders, your lenders, your shareholders, other investors, your board, right? So at Dynex, this co-CEO structure that we have allows we are each other's wing person. My co-CEO goes off to do mostly board things and help me out on the strategic side. I can operate the business, and then we're so tight at the hip that and there's seamless communication. I think of us as like sharing a brain, which we've done together for a long time. Actually, I have a great teammate in my co-CEO, Boston. We've worked together for almost 30 years in different places, and we've been friends for over 30 years. So it's really awesome to work with a teammate like that. But a way we've solved that here at Dynex is to have the co-CEO structure, because we recognize, this is when you're building a business, you need two brains that can do it. And eventually, like a lot of companies will transition one way or the other. It doesn't matter. This is the structure that really works for us. And I think that's how we've addressed that.
It sounds like you literally have two people you're able to divide and conquer a little bit, and have different areas of focus. Kind of on that front, and with public markets, one thing we like to ask public company CEOs is how do you actually track your stock? And a lot of public company CEOs say, well, we try not to look at it, and we tell our people to not look at it, ignore it, just stay the course and stick to business. But I'm curious, do you have on your Apple Stocks app, do you have Schwab or Robinhood? Do you have an email maybe you get from an advisory that goes a lot deeper into flows and volume? How are you tracking your stock on a daily basis?
Yeah, so I have like a major confession to make here, because I have been a bond trader since 1998. So watching the markets is in my nature. And I've been a Bloomberg customer since 1994. So I have Bloomberg on my computer, I have Bloomberg on my phone. We are a financial company. And so, truth be told, like I track my stock every day, several times a day. I at Dynex, our compensation, executive compensation, is primarily based on the total economic return we generate and the total shareholder return. It's the return my shareholders eat, right? And I'm compensated on that. Therefore, I have a high degree of focus on that. So Bloomberg is my place to look at the stock, and I do look at it every day. We track it every day. We have a process internally that will flag when things go a certain way or another. But it is a big focus for us.
I think that's a great segue into looking beyond Bloomberg. Are you getting any newsletters, podcasts? Are you going on Reddit or X or some of these places where the next generation of investors are gathering? They're talking about these things. Do you have a favorite news source beyond Bloomberg that you're looking at, maybe not on a daily basis, but you're getting on a regular basis, weekly or monthly?
Yeah. So I'm a religious reader of the Morning Brew newsletter.
Oh, wow.
I
Okay.
actually really like it. And every once in a while they throw in like a Gen X music reference, and I'm like, oh, yeah, like I know that one. I wanted to connect with that audience a great amount, in the sense that generation, many of Gen X and my generation, grew up in a different finance and investing environment than the people who were seeing markets and stocks and returns today, right? Um, the in today's world, it's not uncommon to see something come to IPO and then go up 500 times that original price. And a lot of times I feel like young people coming into the markets kind of expect that out of every stock that is out there. And the reality is that's not how it has worked. We are in a unique environment. There are some sectors that are going to, just go gangbusters that way. And what I wanted to say to young people looking at investing today is this idea that yes, those types of investments do belong in your portfolio. And there needs to be room for things like cash, believe it or not, and cash-like instruments, bonds, and stock like Dynex, right? So our thought process is we're going to deliver our shareholders a consistent return in the form of dividends over a long period of time. And the cool thing about a stock that pays dividends is that, so for example, we pay a 16% dividend today, 16-ish%, is that you are protected 16% every time you get a dividend. So every time you get that dividend, your holdings are actually protected. So that is something from a risk management perspective, a diversification perspective, you might want to consider as you're thinking about investing. So there's investing for growth and like explosive upside, and there's investing for income and just having some money that's going to show up in your account like every month. We actually pay a monthly dividend that helps you feel like you're getting a cushion, and then you can either reinvest that back into Dynex stock or invest it in something else. So that's kind of the message, if you will. But yes, we do look at a lot of these forums. There's a lot of people that talk about Dynex. One of the things we're finding, though, is that this idea that, income stocks are boring or they're for boomers or, whatever else. They're actually for everyone. They belong in portfolios for everyone, because we've not yet seen in the last 5 years, at least, after COVID, a market where stocks and bonds have been inversely correlated. Typically, when stocks fall, bonds rise, and income-oriented strategies are going to outperform. You don't want to wait till then to go try to re-diversify. So it's good. It's a good idea to have some. You don't have to put all of it in there, but that's kind of the thought process. But we see a lot about just the explosive side of things, and perhaps not enough of saying, hey, there's something to be said for having an allocation to safer assets.
On that point, I like that answer a lot. How do you think individual investors, retail investors, the next generation of investors, how do they discover Dynex? What is that initial aha moment of, oh wow, this is a company I might be interested in investing in?
So the story we like to tell, and we are telling it in many different places. You found us on LinkedIn. We say this on our website. When I'm out talking to investors individually, I do talks with big brokerage houses in terms of speaking directly to financial advisors and such. Um, I tell them two things. We're a company that does good and we do well. And we don't think the two things are mutually exclusive. We treat our people well. We treat our shareholders well. Our shareholders are at the focus of our thought process when we're managing the business. We prove that by having a significant ownership stake, myself, my co-CEO, my CFO, the management of Dynex collectively owns a higher percentage of Dynex than most other companies in our space, the managements of most companies in our space. So we may be, I think, like the seventh or eighth largest shareholder in the company. So we eat our own cooking, right? And then the second story I talk about how retail investors get interested in us is the power of the dividend. So again, as I mentioned, like since IPO, a 500+% return through last night, a lot of that is in the form of a dividend. And because of our unique structure, we're a REIT, we can pass through more of our income because we don't have to pay taxes on it. So we give you this tax advantage yield. And that is what people come to Dynex for. People want income-oriented strategies, or they're just trying to diversify away from NVIDIA or something else into something that can give them a little cushion. And that's how they find us.
Double clicking on that piece, when people are looking at the space, how are they comparing you maybe against your comps, your peers, when they're looking at REITs or dividend oriented stocks? How are they looking at you guys versus the next option?
Yeah, this is such an interesting thing, Matt, because often people will simply look at a stock versus its comps and say, oh, well, this stock has a 15% dividend yield. This one has a 12% dividend yield. And so you're trying to make the decision based on that. What I would say to them is go back and run a very simple total shareholder return analysis over several periods of time and figure out which company has delivered the highest shareholder return, right, over time, but not because past performance is an indicator of how things are going to be in the future, more focusing on time periods where there have been stress. So for example, like Dynex's performance in 2020 was amazing. Like we produced the total shareholder return that year of a positive 15%, right? And so why did we do that? How are we able to do that? So those are the factors that I would consider. So yeah, look at the dividend yield, but look at the total return. Look at how the company did, what management did during periods of crisis. And right now, so for example, like we are in this ETF called REM, and we may be, I think through last night, the second best performing stock in that index since 2019. So and this is post COVID, like COVID and post COVID, and it's not been an easy time, right? You had COVID, and then you had a Federal Reserve hiking cycle, and then now we've got this election uncertainty, and then last year, and then now we've got all kinds of other uncertainties. So to produce that return in that time, that's the thing you want to think about. And then the other piece I would say is like the quality of the management team, the experience. What are they telling you? Are they telling you that they're going to take care of your money? And that's something we take very, very seriously. Like we are taking care of our shareholders' savings. I'm a steward of their savings. And so I want to behave in that manner. So those are some things where, I think there's qualitative factors that people need to consider. The quantitative, obviously the numbers speak for themselves. I think we have among the best track record in the REM. And if you just take a smaller subset, we're number one.
Looking at the different cycles, you mentioned COVID, you mentioned this rate hike cycle.
Mm-hmm.
how does the macro affect the category? So rates are starting to come down. How does that affect your particular category? How should retail investors think about macro rates when they're looking at dividend stocks or REITs in particular?
So the number one thing is, it's been amazing to have cash return 5% in your money fund, right? If anybody who's got cash, they're sitting there, it's like, wow, man, I'm getting like a real return on cash, right? So, but that is going to start to change here. If you've got a slowing economy and you've got interest rate cuts coming, all of a sudden cash is not going to return you 5%. So you've got to find things that are going to return you something more than cash. And this is where fixed income strategies really come into play. And when in kind of technical terms, we call it like real rates. Real rates are positive, and the investments that we make, so which are in mortgages and mortgage-backed securities, the returns on those are about as good as I've seen them in the 30 years that I've been doing this, right? So it's a very unique time period for companies like us, and there's probably 2 or 3 other companies that do it alongside us. So we're seeing an amazing investment opportunity. So retail investors, you're thinking about like, hey, what's my return on cash? If that's starting to come down, what can I reallocate into? Where, if I'm not really psyched about buying the S&P at 6,300 or Nvidia at whatever ginormous stock price is at, or Tesla at $460, what can I do? You've got to consider alternatives. You can consider bond funds. You can consider fixed income dividend paying stocks like Dynex, right? So that is the calculus, I think, at this point. And yes, when front end rates come down, when short rates come down, investors can be thinking that way. For us, it's an advantage because we finance our investments with short-term borrowings, and that as that comes down, our ability to preserve our net interest margin, because we earn the yield between the mortgage-backed securities we buy and these financing rates after we hedge them out. And so there is this benefit of preserving that, or at least perhaps even increasing it over time as rates come down.
Super helpful to understand that. And I think the other piece that we like to ask public company CEOs is how has your role affected your personal investment philosophy? Has being a public company CEO, and obviously you've been at Dynex for a while, but how has that maybe shifted? And you mentioned being one of the largest shareholders of Dynex, so that sounds like that's a big part of your personal strategy is betting on yourself and the company. But curious if being a public company CEO has changed your personal investment philosophy as well.
There is a guy named Peter Lynch, who is a famous investor in the early 80s, and his philosophy was buy what you know. All right. So my philosophy has been buy what I know. And over time, I will tell you, it has made me a very conservative investor. So I have missed out on like gigantic S&P rallies and things like that. So I tend to actually allocate. I have a lot of cash in my personal life. I keep a lot of cash in money funds and such, and then I invest in things I know. And right now, I know Dynex, and that is a big part of my personal net worth. And I think for my shareholders, it creates a lot of alignment with them, because I am, I'm there in the boat. I am making decisions as a co-owner. But personally, that is what it has done. It has made me a very conservative investor away from the businesses that I run. And right now it's all about the company that I run.
Invest in what you know. That's very much a retail philosophy and ethos. They're investing in the products they use. They're investing in what they see from friends, what they see online. We went down the rabbit hole a little bit on social media. We looked at Reddit and X and YouTube, and would love to hear your thoughts on this growing community of amateur analysts. So we did see a few folks on like YouTube that were covering the Dynex stock, and they're not professional analysts. maybe they have a CFA, maybe they don't. But how do you guys view that? How do you think about that content? Is that influencing sentiment around Dynex? Would love to get your thoughts and feelings around these types of analysts that we're finding on social media.
So the good news is, I think, I don't believe that any press is good press. I actually don't believe that. For companies like us, like who are trying to grow, you need good press, right? And to the extent, and you create your own reputation. Your reputation precedes you. From what we can tell, when we go out and search all these different platforms, the sentiment about Dynex is overwhelmingly positive. So people recognize the management as being ethical stewards of capital. And many of them have recognized sort of the track record that I mentioned to you. Some of them have not. It's a little bit confusing. But actually, if you just go back and run total returns of us versus other companies over significant periods of time, you will see that we have been an outperformer, right? So part of this, having people analyze Dynex and talk about Dynex is a good thing. Do they get every little nuance detail correct? No, they don't. These are not simple businesses. And they are simple businesses in some ways, but they're not, right? So if they were that simple, everybody would be doing it. But they're not simple. So you need expertise to actually run the business, to be in the business, to run a public company. But the foundational elements, they're getting right. What does this company do? They invest in mortgage-backed securities. How do they do it? They raise capital in the public markets and they finance themselves in the short-term financing markets. How do they make money? When their assets yield 5 and their liabilities yield 3, they make 2 points, right? Those things are all correct. Now, in the framework, this is the crazy part. In the framework of SEC reporting and GAAP rules and everything else, a lot of that gets jumbled up. So a lot of times people only have 2 things they can see. They can see the dividend yield and the stock price. And I would say that's a great place to start. And as I mentioned to you earlier, if you've got those 2 things, you figure out how management's getting paid, you look at the track record, and again, track record with an asterisk saying not past performance for future returns, but past performance during periods of stress. And we have a competitive advantage in that. And that is, if you can take those things and put together a thesis for that, yes. And then there's ways where I thought it was actually quite good. Some of the ones where they said, is this company rich or cheap right now? And they use the technical analysis to say, look at the RSI and things like that. In our industry, we have something called price to book, which is another metric for people to follow. So a lot of the folks, I think, they're getting 80% of the story. There's a little bit of a nuance that more, I would say, people that are looking into GAAP financials might pick up. But it's really good for us to have that exposure, and it's good for people to talk about companies like us, so that there is something out there to be said for what I think of as more conservative fixed income strategies relative to what's your next 10-bagger stock.
Yes. Kind of on that point, do you see some of the gap closing between institutional grade analysis and retail with the advent of AI tools like LLMs, even just generic off the shelf ChatGPT, and then more specialty tools like FinChat or Fiscal, where a lot of these, again, amateur investors or amateur analysts, they're starting to get more access so that they can do the deeper analysis that you mentioned. Is that gap closing, or maybe is the average staying the same because you just have more people entering the market, and so it's kind of hovering around the same level?
So this is Smirthy's perspective, right? Take it for what it is. I see the gap is beginning to close. And I also see the gap as having the opportunity to close quite significantly. The way, there's not that many publicly traded companies in the US. So there's not that many. And and I'll take the second here to kind of like make my pitch about what index investing actually does to investors. So index investing has created this interesting place where, you know, a lot of the money is just passive money. It's buying the index. And as a result, the largest companies get the most capital, but they're not necessarily the best performing companies, right? So a lot of people say, oh, well, I'll just go ahead and buy the index fund. Okay, go ahead and do that. And so it's created this whole cottage industry of people that are now trying to beat the index, right? And those people are the ones that really are doing the deep analysis of the individual sectors to figure out like what is really cheap and how can I buy more of that so I can beat the index. And they're talking more about performance. And I feel the more that happens, that's going to start to shift the idea of, like maybe like index investing isn't really sort of the best thing in the long term, simply because you're not getting the best performing companies. You're just getting the largest companies. And if that's not what you want, then you do need to do the hard work of figuring out which ones you do want, right? So that part, the opportunity here for these LLMs and amateur investors coming in, doing the work, all of a sudden, I think is going to start to shift the narrative around companies that are actually performing well and perhaps, driving a reallocation of capital to where it's being used well and generating returns, like real good returns for shareholders.
I like that take. It's very contrarian. And again, we talked about retail investors getting more access to institutional grade tooling and even data that's allowing them. And I think the idea of index being the safe play, but not necessarily when you have the access to these toolings and you can actually do the deep work to beat the index. On the social side, when you guys are looking at communicating, you guys do a good job of leveraging these different platforms, getting your message out to the market. How do you approach that internally? What's the planning process? What's your strategy? How are you measuring the impact of these different types of activations or campaigns when you're delivering your story and your message to the market?
Yeah, so I'll just tell you, Dynex is we have started this journey in the last 2 to 3 years, and as you know, the landscape changes every single day, right? In terms of like what are people engaging in? Is it X? Is it Reddit? Is it stock twits or something else? Where are people like seriously engaging? One of the places we found a good amount of success is on LinkedIn, and this is really with shareholders that have expressed interest in the things that we're doing, right? We have a very deliberate strategy about marketing and reaching potential shareholders, but also our existing shareholders. We go through a very thorough process of planning our entire social media campaigns. There are metrics related to how many views, how many times people clicked on something, what type of user engagement did you actually get? Did someone sign up to hear more from Dynex? And we've actually had a significant amount of success doing that. What we found is when we're giving people a unique take on things. So we've done a number of things where we've talked about the Fed and how the Fed has been thinking. We did a piece where we basically said, look, the Fed is not going to be able to ignore the amount of debt in the U.S. economy, and the price of that debt is the interest rate that they set, right? Like, and we did that a year and a half ago. And lo and behold, like here you have this administration saying we need lower rates because we have a lot of debt. So when we do engaging things like that, where we've got the foresight to be able to talk to investors, that's attractive to them. So we're getting a lot of positive traction from that. One of the other things we have to be careful of, because we are a public company, there's all these regulations, Reg FD, and I can't really offer securities and all of that. So our legal team is involved in everything that we do and say. And there's almost like a schedule. So we work with a marketing company, a social media company that helps us set all this up. up over time. We're probably going to start very soon a Dynex YouTube channel to be able to talk to investors directly. So that's in the cards. Um, yeah. And again, like we actually have, we have a shareholder line that anyone can email or call us. And we often do get like direct inquiry from our retail shareholders. And, we have a very responsible and responsive IR team that handles those inquiries.
I love that. It's the bat phone almost, where retail investors can call and touch base with the team directly. It's fun to see what you guys have done out there. You've been very active, and I do think that resonates with shareholders. You also have shown thought leadership and expertise and credibility, and that's very powerful. To wrap things up, we've got a few related questions actually on the thought leadership side. Are there any sectors, we talked about your personal investment thesis, philosophy, are there any sectors or stocks that you're excited about, that you're bullish about in the market right now? Obviously not Dynex, but beyond Dynex.
Yeah, I mean, one sector I'm very focused on is actually the crypto sector. And I believe we are seeing the very beginnings of something absolutely transformational in the globe in this sector. And I'm not talking about like Bitcoin. That's not it. It's more the crypto ecosystem. So I'm looking at things that actually provide the foundational elements, the technology for blockchain, the different ways in which it can be used. Those companies are not yet out in the public markets per se, but that is an area that I'm extremely focused on. Not only in terms of for my own self personally, in terms of investing, but also for Dynex. I think tokenization is a very real thing, and it will come to pass, and we will see significant impacts from tokenization in our markets, and that's going to happen sooner rather than later. And I could easily see, for example, Dynex trading in token form as well as in QSIP form, and that being something, and the technology that drives that is actually the really good investing opportunity, right? And outside of that, I think a lot of these trends, it's a little bit like the rising tide floats all boats, because many companies will benefit from these technologies, but they're going to need to depend on some group of companies that provides that foundation. That's the investment opportunity. So it's not here yet, right? But I am very, very focused as a CEO, not only personally but professionally, on what that foundation looks like, from both a business opportunity as well as an investing opportunity.
Yeah, it's fascinating. It does feel like the technology around capital markets is accelerating, and it does feel like a lot of the DeFi types of technologies are intersecting with the traditional finance technologies. Looking at actual companies, maybe for inspiration in how you're leading the company and how you're operating, do you have any companies that you look at that are inspiring or that you model yourself after out in the market, past or present?
I like Patagonia as a company. I like the ethos of the company, how they treat their people, how they respect the planet with respect to human activity within the planet. It doesn't really matter what you believe. Human activity changes things. Whether you don't need to judge it for better or for worse. I just think you need to say, look, we do affect it. And we need to be cognizant that we're doing that. So part of it is, again, I go back to this idea of doing good at Dynex as well as doing well. I want engaged employees. I want happy employees. I spend a lot of time, this is something personal to me. I want my employees to be happy. So I spend time on that. And I feel companies that actually care for their employees truly are the ones that end up succeeding. So I'm always on the lookout for companies that model that in a significant way. And that is a company that does that.
Let my people go surfing philosophy of Patagonia, and it's a very impressive company as far as empowering those employees to pursue their passions, and that makes them that much more productive when they're actually working.
Yeah, happy employees often and almost always equals a successful company. Engagement is really important. Commitment is really important. People need to know that you care about them and their human existence, and that is how I run this company. And that's so when I see that and reflected in other places, it always feels good. Companies that are bigger than ours.
Mm-hmm. Well, we're almost at time. Last question: if you had a message to send out to retail investors today, existing or potential, what would be that message from Dynex?
The number one thing I'd say is you want to think about whenever you put your money into a stock, that management team is managing your money. So you want to be mindful of who is managing your money. And at Dynex, that is the core principle by which we operate the company. So ethical stewardship of our shareholders' capital is number one. I would tell you that our dividend yield of 16+% right now offers a significant cushion to market volatility. And that the opportunity that we're investing in right now is a historic opportunity. And as I mentioned, it's about as good as I've ever seen it. So the upside in terms of positive total return is pretty significant. And as we've said in our shareholder calls and things, we've actually called it a generational opportunity. So you have an opportunity here at Dynex that is to invest in a generational investment opportunity in agency mortgage-backed securities. You're earning a double-digit dividend yield, and it's a company that's run by people that really care about their shareholders. And I'd invite them to come be part of our journey.
I love it. Smirthy, where can people find more information on Dynex? Do you have any personal social channels that they should be following? Where can people find you online?
So we are on the web at dynexcapital.com. You can just find an overview of the company there. We're on LinkedIn. That is the place. I'm on LinkedIn. So if people want to connect with me directly, I'm actually pretty good about seeing what that engagement channel is. Those would be the two places I would look.
Amazing. Smirthy, thank you so much for the time. It was a fantastic conversation. I learned a lot. Excited to see the response from this episode and hopefully have you back on in the future.
Wonderful. Thank you, Matt.
Thanks for tuning in to Marketopolis, powered by Stakeholder Labs. If you enjoyed this episode, make sure you're subscribed so you don't miss upcoming conversations with the leaders shaping modern investor relations.